As you can see, they all start with the net income, and that's why it's in the profitability section. And I like to see them as stories, a story of efficiency, of leverage, of quality. So if we start with the return on asset, the return on asset is really the story of how the management have used the assets that it controls to generate profit. So it's basically an indicator of management efficiency. Return on equity is a similar idea, but it's more from the shareholder perspective or point of view, because we as shareholder have put this amount of equity to work, and we're asking ourselves how much profit did it generate for us. So it is a measure, if you want, of how attractive the investment is. Now you can break the return on equity into components, and I broke it down here into small steps for you to see how it turns into the Dupont three-step formula. Every time you add here you add the average asset and the denominator and the numerator, so it both simplifies, and this is how you expand it into those three steps. Now for the net profit margin, this one is more about the pricing power and cost, because it tells you, like, starting from revenue, how much do we keep as net income per unit of sale. So is it like I sold for $1, and out of this $1 I managed to keep 10 cents, or is it 15 cents? How much I kept as profit is the information in percentage that is given by the net profit margin. So the higher it is, obviously, the better it is. Now, a very important rule that you need to remember is that every time you mix an income statement element with a balance sheet element in a ratio, the balance sheet element must be average over 2 years, beginning and ending. So you see here it's net income, it could be like for 2025, that's fine, but the average equity is not the equity of 2025. It's the average from the year before to this year, and that's the case every time you see a balance sheet item, whether it is inventory, whether it is liability, it doesn't matter. Balance sheet, you take the average.